Does the unemployment rate have the Fed stuck in its own policy trap? Has the manufacturing sector peaked? And what does that mean for stocks? And with all this talk about the Fed tapering its mortgage-backed security portfolio, can the Fed actually do that? Answer those questions and more on today's Macro Show. I'm Steve Van Metre, and thanks for joining me today as we take a different look at macro world from another part of the kingdom. Now, for those of you who are wondering why we're over on this part of the kingdom, well, bonds are about to break out, the dollar's soon to follow, and for those of you who watch the Sunday Night Chart Show, we'll dig into more of that on Sunday. So let's talk about what's going on with the Fed. We've discussed how with the reverse repo problem that they're stuck in a policy trap. And if all goes well, I'll have a special macro show for you on Monday, even though the markets are closed, where we dig even deeper into the trenches of reverse repo and see what it means for the economy and the dollar, unemployment, and bonds, and all those other factors. But what does this have to do with the unemployment rate now? How is the unemployment rate trapping the Fed? Well, it has to do with the Fed's dual mandate. Well, one of them, it's pretty laughable, is the stability of prices. Now, we know the Fed has no ability to keep prices stable, and they're certainly not doing a good job of it. But the idea now is perhaps the Fed needs to taper or cut back because it is responsible for all these higher prices. But what I want to focus on, because of today's payroll report, is maximum employment is the highest level of employment or lowest level of unemployment that the economy can sustain while maintaining a stable inflation rate. So does this suggest that with inflation heading higher and the belief that it's going to continue to go higher, that we're at the highest level of employment and that the Fed needs to taper here with the knowledge that millions of Americans are going to be trapped on unemployment benefits just to cool off inflation? And by keeping them out of the workforce on a lower wage through unemployment, is that we can curb demand and bring unemployment down? Does that really make sense? Is that really a policy outcome the Fed can achieve? It doesn't make a lot of sense, but let's dig deeper into the data here to see what we can find. And I want to start with the weekly unemployment data. Now, we tend to look at this anyways, but let's dig a little bit deeper into this, is that we see initial claims in a good way fell from 415,000 to 364. Now you might be thinking, well, that is wonderful and it is good news, but does it mean the economy is healthy? Well, here's a chart of initial claims, and I want you to see, and we could go way back in time, but typically in a healthy economy, you're going to see somewhere around the low 200,000s per month of initial claims. And that is completely normal. That's exactly what you want to see. There is normally turnover in the labor market. But at 364, we're still about 50% higher than the norm. And if there's any doubt in that, let's zoom out and you can see how it stays at this low 200,000 range as the economy gets healthier. So the number is way too high still, suggesting there's a problem. Now, the unemployment claims from the pandemic benefits are going away in a little over 2 months. On September 11th, they end. And right now, there's over 11 million people on pandemic unemployment assistance that are going to lose that extra benefit. And without any extra data, there's no telling how many of those people are going to lose their unemployment altogether. That they're not just going to lose the federal benefit, that they might actually lose a state benefit because they've been on it so long. So now we've got 14.6 million people, which is good. It's been declining. It only fell 180,000 last week, which I thought would be a lot more, because remember we talked about how several states dropped their pandemic benefits. So I thought, well, that would lead to more people falling off that, but not that many. And if you're wondering, well, maybe they're lagged by like a lot of government data. Usually the unemployment claim data, sometimes there's mistakes in it, but it's not lagged. Then they'll fix the mistakes usually within the next week. So that's not the issue here. The issue is perhaps the states that are still offering this benefit are where most of the people are unemployed. And that's dangerous because on September 11th, there's a cliff coming in the unemployment world. And so if you start thinking about this from a demand perspective and inflation, if all these people are going to lose at least their extra $300 a week benefit, if not more, how that leads to sustainable inflation, well, doesn't make a lot of sense, nor does it make sense that the Fed would cut their mortgage-backed purchases prior to seeing what happens after the pandemic benefits go away. But there's still a lot of suggestion that the Fed will start talking about this at the upcoming meetings, with the expectation that we'll see the mortgage-backed benefit start to roll off as they curb their purchases. Now, they might offset it with Treasury purchases. We don't know. But I have a suspicion that the Fed's not even going to get far enough along the way to cut their mortgage-backed purchases, because as we've talked about, home buyer expectations are really low. And if enough people stop buying homes, well, that means prices are likely to come down. But let's keep digging into this employment situation, because I think it's getting worse. And we can tell that by looking at today's data. We have the non-farm payroll report, which beat expectations, 850,000 jobs created. So you're saying, well, wait a minute. How can that be getting worse? Well, the reason is the unemployment rate went from 5.8 to 5.9%. And if the Fed's gauge, remember, of what they can do is based on maximum employment, and the unemployment rate is rising, you start asking the questions, how could the Fed taper unless they believe we are already at maximum employment and 5.8% is the best this is going to be? Well, we know that's not true. We know it can be lower, and so does the Fed, especially when we see all these people on some form of pandemic or not just pandemic, but state unemployment benefits as well. Let's dig a little deeper into the non-farm payroll report, because what we find is going into the peak before the pandemic, you had 152.5 million people employed, which is phenomenal. And now, and we're going to round down just slightly to keep the math simple, 145.5 million people employed, putting about a 7 million shortfall of where we need to be just to get back to the pre-pandemic levels. But if we were to extend this line out here along this trajectory, which is pretty smooth, well, we're short over 8 million jobs, if not more. And that's the problem here, is there's a huge amount of slack in the labor market. And so the Fed's job from a maximum employment perspective isn't done. And the idea that they could taper this soon, well, I don't think they can. That's why if there is any talk of taper in the mortgage back, it would likely be offset with purchases on treasuries. Let's dig into this report a little bit more, because there's some other problems with it that don't make a whole lot of sense. Let's start with average hourly earnings, up 0.3%. But if we look at the trend, they're heading lower. Here you can see they're up 0.7, now 0.4, now down to 0.3. They're still increasing, but if there truly is a labor shortage, which is what employers are saying, and people don't want to go back to work, and that the only solution is to raise wages, well, this trend it says they're rising, but they're rising at a slower rate, and that doesn't make a whole lot of sense. The average hourly earnings on a year-over-year rate went up to 3.6%, probably some pandemic data still keeping this number artificially high. But how about this, the average weekly hours? So if you do have employees and you do have demand, and then what's your solution as an employer if you can't get the employees you want? You increase their hours they work. You offer them overtime. You give them more hours. And yet last month, they went from 34.8 to 34.7. So that doesn't make a whole lot of sense when you start digging into this. Now, we do know most of the jobs that were created were in the services sector. That's not really a surprise at all. Some other things that kind of bothered me, other than just the unemployment rate going up to 5.9, is the participation rate. And the participation rate is those who are participating in the labor force, either they have a job or they are actively looking for a job. And so in a healthy economy or a economy coming out of recession, you want to see the labor force participation rate rise for two factors. One, people are getting jobs, and number two, the people that don't have jobs are seeing other people get jobs, so they re-enter the labor force. So you want to see the labor force participation rate rising. But it didn't. It stayed flat at 61.6%, suggesting that there was no change in the amount of people. So more people got jobs, but no more people entered the pool of people looking for jobs, and that stayed static. And so the labor force participation rate has been trending sideways, which is hardly inflationary. If you're thinking about jobs creating inflation, you want to see this number go up. but there's some downward pressure being put on this. And I've met with my buddy Jay Bravo this week, and we're scheduled. The show is scheduled to air on Sunday, so JB, a little pressure on you now. You've got to air that episode for sure. But we talked about the negative aspects of QE and what's going on in the market, and here you can see just that. You see the labor force participation rate in red against the money multiplier, which is the money supply divided by the monetary base. And so you can see the Fed is putting some downward pressure here on the blue line. Because when the money multiplier is rising, it's telling you the money supply is rising at a more than proportional rate to the monetary base, and that's getting monies getting out, potentially out into the economy. It can create inflation, leads to jobs and other things as money circulates through the economy. And you could see that in the labor force participation rate. While not quickly rising, it was slowly trending higher as the money multiplier went up. And then you see the two go down together, the two rise together, and now you see the money multiplier falling. And without government transfers, we know in the months to come that the money multiplier should continue to fall, and is putting a large amount of pressure on the labor force participation rate, suggesting that as financial conditions tighten, that people will give up looking for jobs, and that we may find ourselves at peak employment, which would be very, very dangerous. So, from the perspective of the Fed being able to taper off its $120.5 billion a month, I don't think they have the latitude. Maybe they will start with the MBS later this year, early next year, possibility, but I'll say the probabilities lie with if they do, and I'm not convinced they will, that whatever they stop taper on that side will be added back on the Treasury side. And so now you can see that the Fed's own mandate of maximum employment has got them in a trap, because if the unemployment rate is rising, they can't taper. They might be able to offset one side, but they can't on net taper their book and get away with it. All right, let's get back into the economic data, because there's certainly some very interesting things in here. So let's rewind backwards into Wednesday. Well, that's Thursday. Yeah, we need to back up a little more. Is there anything on Wednesday we need to see? And South Korea exports and imports surging year over year. There's absolutely demand for production, so that's good numbers. But of course, we're still seeing some of these year-over-year comps due to the pandemic's lows set back last year. And looking at Canada, the manufacturing China, the manufacturer, that is not the Canadian flag, that's China. The manufacturing PMI came in at a slightly slower rate, still expanding, but expanding at almost a snail's pace here, 51.3. Remember, over 50 is an expansion, and how far over 50 is the rate of that expansion. So 52 last month, 51.3. So when you're looking at the manufacturing sector in China and you're tying that back to global demand, well, you would expect to see the Chinese manufacturing sector surging, not seeing it there. Let's continue on into the Thursday data and see what grabs our attention. How about Italian manufacturing PMI? Expanded at the same rate, 62.3, 62.2. That's still a good clip. The 60 is a good number. How about we head up to France, 59.4, 59.0 in June, so virtually unchanged from the prior month. So still growing at a pretty good clip. How about Germany, 64.4 last month, 65.1, so expanding at a slightly faster rate. Again, we see some evidence of peaks here. And looking at the Eurozone, the broad Eurozone, virtually unchanged, 63.1 to 63.4 in June. So you're seeing some evidence, as we talked about last month, peaks in the manufacturing sector. Heading even further up north to Great Britain, we see it's expanded. It's just a slightly slower rate, 64.2 to 63.9. So again, evidence here as we move into the U.S. data here shortly of peaks in the Eurozone manufacturing sector. And moving down to the U.S. data, challenger job cuts. These are usually large corporations that are announcing job cuts. This is normalizing now at a little over 20,000 jobs. So that's a good sign. Perhaps they've already laid off everyone they wanted to. Looking at the initial claims data, we already looked at that. and into the manufacturing PMI. And we have two of these. We have the market manufacturing PMI went from 62.6 to 62.1. So still the U.S. manufacturing sector is expanding, just at a touch slightly slower rate than the month before. Not a big deal, but a potential evidence of peak here, which we'll look at a little bit deeper as we get into the ISM data. Construction spending, this is a bit old, of May, so it's a bit behind, went from 0.1 to minus 0.3%. The year-over-year percentage change is still pretty good, but the month-over-month went a little negative. But how about we move into the official ISM data, and we'll head over to the ISM website. Why is it the official? It's what the market considers the gold standard for the diffusion data from the manufacturing PMIs. And let's start with the headline PMI, coming at 60.6 from 61.2 in May. And what does that tell you? Still expanding at a good rate, just a little bit slower. Now, from a peak perspective, we'll look back at the last 12 months and we see that in March, we had the high point of 64.7. It went down to 60.7, 61.2, now 60.6. And usually the equity market peaks around 3 months after that, because there is a high correlation between the stock market and the manufacturing sector. So all this is doing, and it doesn't mean the stock market peaks exactly 3 months. It can be a little shorter, a little longer. It's just putting the stock market on notice that you can keep rallying here, but your time is limited. Let's take a look at new orders. Actually, let's go back up to the consolidated data. New orders expanded at a slightly slower rate, not much difference in the month before. Production expanded at a slightly faster rate. Employment, now we saw this in the employment data, that manufacturing sector didn't post a lot of job gains. No surprise. May was at 50.9, June was at 49.9, so effectively unchanged, so no growth in payrolls from the manufacturing sector, which was validated. Supplier deliveries expanded at a slightly slower rate. Inventories, very slightly higher rate. One thing that I find interesting is this backlog of orders. Now, backlog, you can see it went from 70.6 to 64.5. So it's expanding at a little bit slower rate, but 64.5 is still pretty big. Now, there's two types of backlogs. There's a backlog from demand. So I have a product and there's just so much demand. I've got purchase orders just going, piled high that I can't keep up with them. There's also a backlog that says I have nearly finished products, but I'm missing maybe a component or two, and I'm waiting for that to get in so I can finish them. This doesn't tell us which that is, but I think it has more to do with supply shortages than it has to do with demand. We'll see. Looking at prices paid, I think this is the highest level in over 40 years, at 92.1. Most firms now reporting even higher prices. The bond market usually doesn't react until this peaks, but the bond market is telling us that these prices paid, they're not going to last. The bond market has said that since March. And now on back to the data. So indication that's peaking in the ISM tells us that the stock market peak is soon to follow. Moving down into South Korea, we'll look at the CPI month over month, went from 0.1 to minus 0.1% in June. That's deflationary. In case you're not sure what that means, it is deflationary. Total vehicle sales in the U.S. dropped from 17 to 15.4 million. Now the data says that you think, is that a demand decline? Apparently the dealers don't have any cars on their lot and people want to buy. So this is being billed as a supply shortage, that there's still plenty of people out there that want to buy cars as soon as they can get on the lot. Kind of suggesting that this backlog of orders in the manufacturing sector is high, simply because they don't have the parts they need to complete the things that they have to sell. Looking at producer prices in the Eurozone, up 1.3% month over month in May. So definitely producer prices going higher in the Eurozone, jumping 9.6% from this time last year, which is huge change. Let's get into the rest of today's data. We see in Canada up north. From me, exports went down slightly, imports up slightly. So on net, not much of a change, meaning the Canadian economy would be stagnating. You want to see imports and exports rising if the economy is rising. Look at building permits, down 14.8%. Could be dangerous for the Canadian real estate market, but I hear nothing stops it from going up. That's what I hear. I haven't seen it for myself, but it's what I've heard. Here you can see all car sales down, truck sales down. And now we got the final data on durable goods, excluding defense, up 1.7%, factory orders up 1.7%, excluding transportation, factory orders up 0.7%. So strong data there. And of course, last but not least, we got to go look at the credit data, because it doesn't show you a lot of great things are happening here. How about bank credit? And why do we look at the bank credit? Again, we're looking for people to borrow money, and that's what we need to see inflation in a growing economy. So we want to see a lot of that here. Now we're seeing some of it where we want and none of it in other places. So check this out. Bank credit up $3 billion. Securities in bank credit, those bonds that no one wants to buy, up $9 billion, with mortgage-backed securities up a whopping $11 billion. Does that, do you think the Fed's going to taper? If the banks are buying, do they really think the Fed's going to taper? Probably not. U.S. Treasuries up $4 billion. Looking at all loans and leases at commercial banks, down $8 billion. Commercial industrial following it lower, $15 billion being the big drop in it. Real estate up $3 billion. Consumers driving the borrowing up $9 billion. In cash, that pesky problem of cash in banked assets, up $11 billion. So banks continue to have too much cash. And that tells us a reverse repo problem. Well, it's going to get worse. And hopefully I'll have that special edition out for you on Monday, because the repo problem, well, it's predicted to be getting a significantly worse in the months that come. But we'll talk about that hopefully on Monday, and I'll see you back on Sunday for the chart show. I'm Steve Van Metre. Have a great 4th of July weekend. Bye now. The content of this video is provided as educational information only, is not intended to provide investment and other advice. This channel is not to be construed as a recommendation or solicitation by a security, financial instrument, or participate in a particular trading strategy. This video is prepared by Steven Van Metre personal capacity. Opinions expressed in this video that do not reflect the view of Alice Financial Advice Inc. or Steven Van Metre Financial.